last but not least, the hardest source of funding that you can try to get is from venture capital firms. Now I put this as the last option because it is actually the most hardest to get. It is hardest to achieve and hardest to find because there are not many venture capitalists around the world, or unless you're in the US or you're specifically in the Silicon Valley or in San Francisco. Other than that, there are only a handful of venture capitalists around a certain country. For example, you may have just 1 or 2 or maybe 5 or 10 the most, depending on the size of your country, of course. And they're hardest to achieve because they are looking for high returns and high growth companies. So usually they only invest in high growth businesses, and the kind of businesses that could provide high growth are technology businesses. So startups, tech startups are the easiest to apply for venture capital funding. If you're trying to start a restaurant or a service-based business or trading, you can forget about venture capital money. And they always expect high returns. How high is high? Well, around 5 times, 10 times or more than the money that invested in you. Some people, the general rule of thumb is 10 times. Sometimes they may ask for more. Sometimes they may ask for less. But 5 times is the one that I heard that is the minimum that they're asking for. So if you're not in the high growth business, you may not want to go for this venture capital option. Most of them actually invest in late stage companies. Companies which are in the growth or mezzanine stage. If you're a company that just started without any revenue perhaps, or just prototype, you may not want to find venture capitalists. You want to go for angels. So after you got your money from angels, and assuming that your company is doing well, the next step is to find venture capitalists, or in short, VC. So they're the one who would come after angels in the growth stage or beyond. We will go into more detail about venture capital funding in the subsequent sections. We will look more into venture capital investment in subsequent videos. Let's look at the difference between an angel investor and a venture capitalist. Here we have a table. Let's look at the first one. Angel and VC, in short, take equity in your company. So they give you the money, they want shares in return. Sometimes they take convertible debt or note. What this means is they will first give you the money, but that money is actually a loan, so you have to pay them back eventually. However, in the future, they have the right to convert that money into shares. So if they notice that your company is performing well and very promising, they may instead choose to convert those debt that you owe them into shares. So we will talk about more into convertible notes in another course. Let's look at the next one. Angel investors are usually individual investors. Sometimes there can be a group of angels working together to invest into companies. But VCs are usually a company. They're a company, a registered company that helps with the purpose of investing into other companies. And angels usually use their own money to invest. Remember, angels are usually ex-entrepreneurs who had made a lot of money. So now they use the money to invest into people like you. On the other hand, VCs are actually using other people's money to invest. So what they do is they actually source this money, or they call it the fund, from larger other investment companies or high net worth individuals, and they create this fund where they use to invest into other companies, such as startups. Next, Angels usually invest in early stage businesses, around the seed stage, prototype stage, or pre-revenue stage. On the other hand, VCs usually invest after what angels invested, which is late stage businesses. Businesses which are generating revenue or growing rapidly. And for the amount of investment, angels usually invest less money because they're individuals, they're not a company, so they also have less money. So they are usually investing in an amount of around $10,000 to $100,000. Now you see that I use a lot of word usually here because usually they invest around this amount. However, it is not a must that they invest in this amount. It can be more. I've known angel investors who could even invest $1 million. So all this is just a gauge or just a general comparison between angels and venture capitalists. So definitely it could change as well. So sometimes angels also group together to invest more money into companies. VCs, on the other hand, they invest usually, again, $1 million or more. In your country, your VC may invest less than $1 million or even more than $1 million. Again, it depends. Angels have entrepreneurship experience or networks. They are former entrepreneurs who know how to run businesses. VCs, instead, are individuals who watch over other people's money. They may not have the knowledge or the skill to run businesses themselves. Remember that. But both of these people, they do have their networks. The networks that could add value to your company. And lastly, angels usually want to play a role in your business. They want to be an advisor. They want to teach you because they've learned so much. They want to share the knowledge with you. So they want to be your advisor, they want to be your mentor, they want to help you to grow in your business. But VCs are only in for the money, usually. They just want the dollar and the cents. So they don't really want to get involved into helping you to grow your business. But again, I use the word usually because sometimes VCs are quite helpful as well. They may want to help you to run your business and provide you some guidance or mentorship. So those are the differences between angels and VCs.